JPMorgan, Chase and Blackrock is telling investors to continue on bracing for higher interest rates because there has been some talks among regional banks and even large banks saying, oh, don't worry, the Fed will cut interest rates lower this year. And these two big powerhouses of BlackRock and Chase is saying, no, don't think like that. The Fed will continue on hiking interest rates in order to cool down inflation. Jamie Dimon, the CEO of JPMorgan Chase, and Larry Fink, the CEO of BlackRock, are both experts in their field, and they are predicting the Fed to continue on being aggressive or somewhat aggressive in their battle against inflation. And these two banks are warning smaller banks that these higher interest rates will affect them even more. Now, that's funny to think because these larger banks obviously are competitors to these regional smaller banks. And a lot of these larger banks just buys up these smaller banks in order to build up their portfolio and build up their business. Now, that's one way to think of it, but I honestly do think that other businesses, other banks do want more competition, and they understand the importance of having different competitors at different levels in their industry. They are just looking at the data and stating the facts that, hey, inflation is still at this. Yes, it's cooling down just a little bit, but still brace for yourself. Now, what exactly did Jamie Dimon say and Larry Fink say about inflation and the whole banking crisis as it relates to maybe the housing market and the economy as a whole? Before I let you know what they say, please be sure to subscribe to this channel for some more content around personal finance, the housing market, and the economy as a whole. All right, so Larry Fink, Jamie Dimon both warned of this longer period, bucking the view that the central banks will cut rates lower in 2023. So they're not 100% on that line that some regional banks and larger banks are thinking, oh, the Fed kind of wants to just have a soft landing. They saw what happened with Silicon Valley Bank. They think that they don't want to apply even more pressure on these banks because they are due for different mortgage payments and different things, and they saw the effect. So they're going to start cutting rates later on this year in order for them not to repeat a Silicon Valley Bank failure. But these large powerhouses are saying no. The Fed is going to probably most likely continue on throughout this whole year increasing interest rates. Dimon, CEO of Chase, on Friday said that there could be consequences for investors and companies which do not prepare for the risk of an extended period tighter monetary policy. And so Chase is just saying here, hey, if you want to think like that, you can think about that. But you need to prepare. Don't expect the Fed to change their approach all of a sudden because of what happened. Like, we do need like these mini crashes in order to reset the economy and to bring prices lower, to bring inflation lower. You have some of the banks here. People need to prepare for the potential of higher rates for longer. Separately, CEO Fink said in an interview, inflation is going to be stickier for longer, so the Fed may need to continue to increase it 50 or 75 basis points more. There's a lot of stress in the market. Results from JPMorgan, the largest U.S. bank by assets, as well as Citigroup and Wells Fargo, underscore how largest lenders are benefiting from higher interest rates by charging more loans without passing on significantly higher saving rates for depositors. Now, this is a great point that this article pointed out, is that these larger banks, BlackRock or Citigroup, Wells Fargo's, Chase, Bank of America, that they're benefiting extremely from these higher interest rates because they're making more money on the loans they issue out to their clients, right? And at the same time, you look at your savings rate, if you have like a Chase or Wells Fargo or Bank of America, you're not getting that sort of rates compared to higher interest rates they're getting, right? They're not really passing on that benefit to their clients. And so they are cashing in, especially these larger banks. And so it makes you think, are they just saying this because they do want to increase their revenues and income? And even if the Fed does lower interest rates a little bit, they still will do extremely well because when the Fed lower interest rates, that increases them giving out even more loans. Now, I don't think that's the only reason why they're warning that. Once again, I think these banks, they have their analysts, they have their different experts in their field that does all the research and look at all the data points. And they're seeing, hey, these are the stats right now. This is how it looks. This is how the Fed usually responds to something like this. And we think higher interest rates are just bound to happen. The other interesting thing that this article pointed out is that a lot of these smaller banks have their earnings due in the next couple of weeks. And so they're going to share their first quarter results, their revenues, their income, their net interest income, just how much they're making. And a lot of these banks are predicting that it's not going to look the best, especially in the first quarter of 2023. After 3 banks failed in a week last month, some customers have pulled money from smaller banks over fears that they may struggle to honor deposits if they have to sell these assets at a loss. So a lot of these banks are saying, hey, people are starting to move their money out of smaller regional banks. And at the same time, once these quarterly results come in, that's probably going to create more fear in customers' mind and even more withdrawals from these smaller banks, which is pivotal to our economy because a lot of commercial real estate loans are with regional banks. A lot of major things revolve around regional banks. Markets have for months bet that the Fed will be forced to pump the brakes far sooner than the central bank expects. This is what we've been talking about. For Wall Street financiers, the key concern is that higher rates for longer and the stresses at regional banks that lend to many small and local businesses will constrain lending and do further damage to the US economy. So here, this article, these different points are just saying that, the central bank will probably be forced to, pump the brakes because of how much the economy is dependent on regional banks, because even as a small business, you go to these banks for loans. And if these smaller regional banks are having or experiencing quarterly losses, they're not going to lend as much to people. And our economy is dependent on small business, right? And mid-sized businesses. And so we actually need them to lend out more because that's sort of the bedrock of the economy. First quarter results from the banks on Friday underscored the underlying strength of the U.S. economy, provide another data point that might mean the Fed does not need to lower rates this year. Citi said its credit card customers spent 7% more in the first 3 months of 2023 than they did in the first 3 months of last year. Now, this point is very interesting because people are saying, oh, there's losses here, there's losses there, but these larger banks are just profiting so much. And so the Fed is looking at this and saying, well, these larger banks are doing pretty well. We actually need to have them slow down even more. And so we're going to continue increasing interest rates. And even maybe for some regional banks, they are benefiting from higher interest rates also. Not all Wall Street executives are predicting the Fed will hold firm on rates. Citi Chief Financial Officer Mark Mason told analysts the bank is expecting to flatten after the second quarter and then trend down towards the end of 2023 to about 4.5%. So Citigroup, another major top 5 bank in the world, well, in the US at least, is predicting the Fed to lower interest rates. All right, let me know down below, what do you all believe? Do you believe that JPMorgan Chase and BlackRock, they're right about, hey, you all, the Fed is going to continue hiking interest rates because of these different things happening in the economy? Or do you think that interest rates will flatten out or even lower later on this year? I'd like to know down below. Be sure to comment, subscribe, and like this video.